What is a 1031 exchange and how does it work?
Welcome to another episode of Behind the Scenes.
On this episode of Behind the Scenes, we're going to bring in an expert to help guide us through what a 1031 tax exchange is. 1031 is actually the specific section of the IRS code, section 1031, that covers the, quote, exchange of real property held for productive use or investment. In plain English, that means that a taxpayer may defer capital gains and related federal income tax liability on the exchange of certain types of property. And that process is called a 1031 exchange. So let's jump right into it. All right, I'm very excited to welcome Scott Saunders. He's the Senior Vice President at Asset Preservation Incorporated. Scott is a nationally recognized expert in 1031 exchanges. He's worked in the industry over 30 years. Scott, welcome.
Hey, Aaron, welcome. Thanks a lot. It's great to be with you today.
Absolutely. Hey, one thing before we get started, because this stat just really stood out to me, but you've participated in over 100,000 of these tax exchanges. Is that right?
Yeah, that's right. Believe me, done a lot of them. Started way back in 1988. So been doing them for a long, long time.
Thank you so much for joining us here today, and we're really excited to jump into this.
And likewise, excited to share some great information, for you and your clients up there. And, want to cover a topic that's important. People think it's a little complicated. It really isn't. And what I want to do is hit some of the highlights today.
Perfect. All right. Well, let's jump right in.
Well, thank you, Aaron. We're going to cover just an introduction to 1031 exchange basics, focus on the late exchange, time deadlines, and some of the rules. And for those of you that aren't that familiar with 1031 exchanges, what I wanted to do was just start off and make it very simple. If we look at a normal taxable sale, you sell a property, you give it up, and you get back cash, that's taxable. The only difference with a 1031 exchange is you give up a property and you get back what we call a like-kind property, and that allows you to get tax deferral. So a sale, property given up for cash, exchange, give up property, but then you get back like-kind property. Now, the neat thing about a 1031, it's been, and when I say a 1031 exchange, sorry, a little slang there, but a 1031 exchange has been in the tax code since 1921. And what it does is for real estate investors, it gives a really significant tax advantage. You're able to defer paying capital gain taxes whenever you exchange for a like-kind property. And when we talk about taxes, what I want to do on the next screen is just kind of go over, but a lot of real estate investors aren't aware that if you sell and you don't do an exchange, you really have up to 4 different levels of taxes you could face. So first off, you've got depreciation recapture that's taxed at 25% today. So if you've owned a house, let's say a single family rental for 20 years, every year you get a little bit of depreciation and it helps you out on your tax return. But if you sell it 20 years later and don't do an exchange, all of that depreciation is taxed at 25%. So keep that in mind. That's a fairly significant tax hit. Then any remaining federal gain is going to be taxed at either 15 or 20%, depending on your taxable income. And keep in mind, when you do an exchange, it might bump you up into a higher tax bracket, right? Because you sell an asset with a lot of gain, and now you're paying taxes at a higher bracket than you would without that sale. There's a third tax called the net investment income tax. Now, this is a tax on what is called net investment income, but that includes capital gains. So any capital gains that you have that are over certain thresholds, so over $200,000 if you're single, or over $250,000 if you're married and filed jointly, you'll have to pay an additional 3.8% tax on that. And then finally, you got to take into account state taxes. So depending on where you are, that may not be as big of an issue up in Washington, but if you're selling in another state and coming to Washington, you could be facing state taxes. So you want to look at all 4 levels of those taxes to kind of get a feel of what you would pay if you didn't do a 1031 exchange. And just a tip for everybody that's watching, highly recommend you at least talk to your CPA or your tax advisor before you close escrow and just have them tell you, here's what you're facing in taxes. I find a lot of people are surprised that they've got a much higher tax bill when you add all these up than maybe they were considering. So something that's just a good way to do that, to kind of be aware of things. Now, I mentioned at the beginning this whole concept of like-kind property. And the definition of like-kind property is just any property that you either hold for investment purposes or you use in a business, exchange for any other property held the same way. So you'll see on the screen here all these different images coming in, but like-kind is broad. It could be bare land, exchange for a single-family rental. It could go into a duplex. You could even go into a vacation home that's held for investment if it's treated properly. Or you could go into commercial buildings, industrial, warehouse, office. So all these different things that you see on the screen, those are all considered like-kind property. And so you'll see it's very broad. The definition of real estate is very, very broad. You really just have two types of properties that are not like-kind. So the house you live in, Aaron can probably provide you education on that, but that's called Section 121 of the code, and you can exclude taxes when you live in a house, but you can't do a 1031 exchange on a residence that you live in. The only other type of property primarily that's excluded is what we call dealer property. So this would be or a property that's held for sale. In the world of real estate, you may have heard the term a fix and flip, right? Get a property at a low value, spruce it up, put some paint on it, fix it up a little, and then sell it for a profit. If the intent is to hold for sale, not long-term investment, that's also excluded. So you can't do an exchange on the house you live in or are going to live in. You can't do an exchange on any property held for sale. But other than that, it's very broad. So you can see, the definition on the third bullet point, everything that you saw in that visual earlier really qualifies as like-kind property. So it's a real powerful tool to really build wealth in real estate. And a lot of people might start off with one single family and they go into a duplex and then maybe a fourplex. And then maybe down the road, they go into a couple fourplexes or maybe a small apartment building. So over time, it's a great tool to take that money that would otherwise be going to taxes, redeploy it into better performing investment properties. Now, there are a number of rules, and we're going to get into the time requirements, but I wanted to share with you on the next screen. If you want full tax deferral, there really are two simple things you need to do. Number one is you want to reinvest all of the net proceeds. So that would be after the real estate commission, the fees for the escrow company and recording, all of those things. So the net amount on the settlement statement. And the second thing is you want to have the same or a greater amount of debt. So you look at the mortgage that you've given up, and then when you buy a replacement property or multiple properties, you want to have at least combined debt that is the same, or it can be more than what you gave up. You might hear the term as sometimes tossed around in the exchange world of boot. Boot is just non-like-kind property. So cash you receive is called cash boot. That's taxable. A reduction in mortgage is considered mortgage boot, also taxable if you have gain. So let me just go through a simple example here of kind of a typical property in the Washington area, selling for around $900,000, a mortgage of $300,000, and then cost of sale. So again, the fees at the escrow title company, real estate commissions, things of that nature, leaving net equity of $540,000. Then you're going to go up in value to $1.2 million. So the debt goes from $300,000 to $660,000. So up. All of the net equity is reinvested. So this is an example where there is 100% tax deferral. There's no boot. But I'll just share with you an example here on the next screen where we have some boot. If you start at $900,000 and you buy for $700,000, in this example, the debt goes from $300,000 to $260,000. So we have $40,000 of what we call mortgage boot. The money, the investor keeps $100,000. So that's called cash boot of $100,000. So you add the $40,000 to the $100,000. And then this example, there's $140,000 of what we call boot. So A lot of investors, right now, about 1/3 of all investors do receive some boot. So keep in mind, you can certainly do an exchange that's not 100% tax deferred and still get the benefits. And a lot of people opt for that. What I want to do on the next slide here is just kind of walk you through what the most common exchange is, what we call a delayed exchange. And in a delayed exchange, there's a delay in time from when you sell to when you buy replacement property. So here are kind of the steps. You're at the top, you're the real estate investor. You work with your real estate professional and you get your property under contract. So you're working with Aaron and his team. They list your property, they get it under contract, and then prior to closing escrow, you contact what's called a qualified intermediary, a company like ours, and there are hundreds of companies like ours out there. We, as the intermediary, qualified intermediary, we, through an assignment of the contract, we step into the shoes, we sell the property on your behalf, and because we're the seller, we receive the proceeds. So we get the money and put it in a separate account. Now you're going to work and look for a property that you want to buy. And again, it could be one property or it could be multiple. You make an offer, you get it under contract, and then that contract is assigned to the qualified intermediary. We take the money we're holding for you, we purchase the property, and then we instruct the escrow officer to directly deed it back. So when you look at this timeline here and you look at what's going on, you're just giving up title to what we call a relinquished property, and then you're receiving title to a replacement property. It's actually the qualified intermediary that sells and the qualified intermediary that buys. So we would be shown on the settlement statement on your behalf as selling and buying. Now we'll get into the part where people have some questions, which are the time deadlines down below. Day 0 is when you close escrow. So nothing happens until you actually close on the sale of the relinquished property. But what you have is you have 45 calendar days, so they end at midnight of the 45th day to identify property. You then have an additional 135 days after that, so a maximum of 180 days to close on properties that you've identified within that 45-day period. So 45 plus 135 for a maximum of 180. And then you'll notice on the 180-day, we call that the exchange period. The 45-day period is called the identification period. It's 180 days or the day you must file your tax return, whichever is earlier. So anybody that closes around the middle of October but files their tax return on April 15th, what you need to do is file an extension, close your exchange in 180 days, then go file your tax return. So just a small issue, but most people do this, and that 45 days is set in stone. There's no, I know right now the market has a lot of properties turning over fast and things change over time. No allowance for market conditions. So just be aware that's where the real pressure is in a 1031 exchange. And you've got 3 different ways that you can identify, but the first 2 are the most common. Under the 3 property rule, you can identify 3 properties of any fair market value. So you sell for $900,000, you could identify one at $1 million, one at 1.2 million, and one at 1.5 million. But you're limited to 3 properties. The 200% rule says you can identify as many properties as you want, but no more than 200% of the value of what you sold. So again, if you sell for 900,000, you can identify as many as you want, but you can't go over 1.8 million in value. So that might be something you use if you're going to maybe exchange out of the Washington Northwest market. Maybe you're going to go into the Midwest where values are a lot lower and you want to buy multiple properties. You might use the 200% rule. So in summary, the 3 property rule is an unlimited value, but you're limited to 3. The 200% rule is kind of the opposite. It's an unlimited number of properties, but then the value is capped at no more than twice what you sell. And keep in mind, with these rules, you really just have to fit one of those rules. You don't need to combine them. So you're either the 3 property rule or the 200%. Now you see there's one rule on the screen there called the 95% rule. Very rarely is this used, but if you identify more than 3 and over 200% of what you sold, you then must close escrow on at least 95% of what you've identified. So that's really, really tough to do in the real world. So what I want to do to kind of summarize and walk through it, I want to go through on the next couple slides just the highlights of what happens. Aaron will tell you that the most common format that he sees is what we call this delayed exchange. And I just want to walk you through, just kind of as a summary, what do you want to do in a typical delayed exchange? Certainly, it's beneficial to establish that your intent is to do a 1031 exchange. And it's certainly recommended you consult with both an intermediary, a qualified intermediary, and again, your tax advisor. Your tax advisor knows your unique facts and circumstances. So talk with them, review what you want to do. There might be some other issues that need to be taken into account. There's something that you want to include in your contract to sell the property, your purchase and sale agreement. And we call that the 1031 exchange cooperation clause. And really what it does is it just establishes your intent to do an exchange. It releases the buyer of any liabilities. And then you're going to notify the buyer that the contract is going to be assigned to a qualified intermediary. So you'll see some suggested language. There are different variations, but there's some suggested language there for that clause. Then number 5, it's really important that you get all of the qualified intermediaries documents in place before you close escrow. You can't come back after closing and set up an exchange after the fact. So you've got to contact the qualified intermediary, have them get all the documents on over to your escrow officer before you close on the property. Really, really important to do that. And just a little planning tip for you. You can always convert a taxable sale to a 1031 exchange at the very last minute. So if it's the end of the month and you decide, oh, maybe I do want to do an exchange, a typical qualified intermediary can get documents there within an hour to convert a taxable sale into a 1031 exchange. So those documents are signed. Then you've got that 45-day window to identify property within the rules of identification, and then that maximum of 180 days to complete the exchange. And then finally, the issue you certainly want to look at, there are lots of qualified intermediary companies, but that's a very important decision. They're going to hold your money. So you want to do due diligence on them. You certainly don't want the money held in a commingled account. You want it held in a separate account where it's set up just for you. You want to look at what sort of financial safeguards that they have. Is the qualified intermediary maybe a subsidiary of a big parent company, like a title company or a bank? What other financial safeguards? So just take that into account. There are a lot of excellent qualified intermediaries out there, and they can be a great resource. And then finally, kind of coming down home stretch, I just want to remind you at the end, this is a general overview in a relatively short period of time. So be sure to review your unique situation with your CPA and your tax advisor, because we haven't covered all the issues, but what we wanted to do today was just give you a good overview of kind of 1031 exchange basics and let you know that it's a very powerful tax strategy for anybody to go ahead and acquire a lot more investment properties and do it in a way where you've got the tax code working for you and helping you acquire more properties.
Scott, thank you so much for that very informative presentation. Got a lot out of that, and I'm sure our audience did as well. So thank you for that. One question for you. Is there a scenario where somebody would not want to do a 1031 tax exchange?
Yeah, Aaron, that's a great question. Yeah, there are times. Somebody may not want to do an exchange in a couple of scenarios. One is they might be looking to get out of real estate, right? Maybe they've built up wealth. They've done exchanges throughout their lifetime, but maybe now they want to go sell off some assets, pay the taxes, and maybe put that into other investments because they don't want to be involved in real estate. So I think that would be one scenario. A second one might be, and it's rare, somebody might have what are called carry forward losses on their taxes, where they're carrying forward some investment losses. So they may not need to get tax deferral because maybe they've got some other tax factors that can mitigate paying capital gain taxes. And the other thing we see is sometimes we'll do, and I think I mentioned it earlier in the presentation, A lot of people do a partially deferred exchange. They'll get some benefit, but maybe they want to buy that motorhome for 150 grand, right? They take some money out, they pay the taxes, so they buy one more investment property and they get the benefit. And then they pay taxes on some of that boot. They pick up the motorhome and they travel around. So, an exchange, what I always like to tell people is it's not like you have to do a fully deferred exchange. You can always do a partially deferred. And I see a lot of investors that may do that, or maybe sometimes they find a great property, but maybe it doesn't quite meet those exchange requirements. Maybe it's off by 10 or 20,000. So they pay a little bit of taxes on that difference, but they get all the other benefits.
Got it. That's wonderful. One last question. In terms of when somebody would want to contact you for a consult, if I get a call from an investor that's thinking about doing this, how far in advance would you recommend they contact you to start that conversation?
Yeah, that's a great question. Ideally, in a perfect world, before you even list the property, it would be good just to talk through it. What a qualified intermediary, so I'll be very clear, a qualified intermediary, we can't give tax advice, we can't give legal advice. Now, the fact is, as you mentioned at the beginning, I've structured lots and lots of these, so I know most of the basics. What a qualified intermediary is going to do is kind of review your scenario. How do you hold title to your property? Do you have a loan on it with one? If you're married, is one person on the loan or the other? Are you a community property state? We'll go through the basic requirements for deferral. And then a lot of times we'll talk about and provide just a little bit of input on maybe opportunities that people haven't thought of. We see a lot of people right now, the rural markets, the vacation home markets are very strong because of the virus. People are doing Zoom calls and they're working from home. And so people may not know that they could buy one more investment property and maybe pick up a vacation home that's held for investment as part of an exchange. So sometimes we'll talk through and maybe just give them some ideas of things that they haven't thought about as being necessarily exchangeable. We didn't get into it on the recorded part of the presentation, but things like conservation easements you can exchange, air rights, oil and gas, there's all these different things that can qualify. So talking to a qualified intermediary, we can kind of kick those things around before somebody's actually in escrow and under contract. And that way they can kind of plan and then work with you. I think it's really key when they're working with a real estate professional that they kind of give you some cues of what they want to buy, right? They're selling in Bellevue, and what part of the market do they want to buy in? So you can start telling them, what are the price points in that part of the market? What are the rents like? Because that's where, our expertise as a qualified intermediary is doing an exchange. Your expertise, Aaron, is knowing the market, right? What are the market conditions? What pockets have opportunity? So I think marrying together the expertise on the 1031 side with your expertise as a real estate professional, it just gets them better prepared to make the wisest investment they can.
That's fantastic. Well, Scott, thank you once again. Really, really appreciate your time and sharing your expertise with us. And we will have your contact information below should people want to reach out directly to you. So thank you again.
Thank you, Aaron. It's been a great time being with you. Thank you very much.
Thank you so much for joining us on this episode of Behind the Scenes. As always, we hope that you got a lot out of it and would love to hear from you. So reach out to us, and on social media, we're at JanusGroup RE. Thank you so much. And until next time, take care.
House goals realized. Janus Group at RE/MAX Integrity.
It's a tooth.